Good evening, viewers, and thanks for joining me in this edition of Resource PNG. In tonight's program, we feature two presentations, one from Mick Fell of Wood Mackenzie Consultancy, and the other from Professor Magnus Eriksson, co-founder and senior partner with Raw Materials Group. But first, we join Mick Fell, who will take us through the experiences, challenges, and successes involved with managing resource-driven wealth. Mick's presentation will give us an overview of countries that are looking to diversify their economy away from their initial resource-driven growth into subsequent commodities that will assist in developing new roadmaps and pathways for development of new industries based on new commodities.
Firstly, I'll introduce myself and the firm. We're a consultancy that specialises in resources. Our primary focus is on providing research. We also have an advisory group which I'm part of. Our focus is, and you can tell from the images, primarily on upstream, downstream and gas. But since our acquisition of Balayonka and Brook Hunt, we now look at metals and mining globally through the integration of those services. So we work across the value chain. I've been able to pull on the skills of our global network of colleagues, but also call on the knowledge inherent within the firm to try and give you a feel for some of the challenges facing developing countries from resource-driven growth. Our focus is on delivering commercial insight. We focus, in terms of the coverage we have globally, on the commercial performance of assets or commercial potential of resources. We're focused very much on future cash flows. What is going to happen in the future and what makes sense for us to participate in. I'm not a development economist, I'm a mining engineer. This won't be a development economics lecture, but there'll be some aspects of that. But what it will be is a walkthrough of how we think about resource monetisation. How is it that you take an exploration prospect or target through to development as a project and then into commercial operation? What are the key drivers for success that make a difference? We've done this in sub-Saharan Africa with countries that are looking to diversify their economy away from their initial resource-driven growth into subsequent commodities, helping them to develop roadmaps and pathways for development of new industries based on new commodities. And it's from that framework I'll be speaking. So what has been the experience globally of developing countries in managing resource-driven growth? Firstly, it's not an option for the world not to develop those resources. Non-OECD supply is absolutely key to maintaining supply security globally. Secondly, developing countries have an interesting dilemma when it comes to the scale of their economy and the scale of the opportunity. The riches are certainly there, the wealth will be generated. The question is how it will be used and whether that economy will become too reliant on that income stream. And so development economists speak about the resource curse, and that's something that's worth thinking through. We'll also look at a few peer group countries where we can perhaps learn some lessons, either from challenges, it's always good to avoid others' mistakes, or successes. Always good to copy people who've already been there and done that. And finally, if we think about developing countries, is that really who Papua New Guinea will be competing against? In many ways it will be, but Papua New Guinea's opportunities are all about its natural resources endowment. It's about the geology and about the geography. It's about its market position, its proximity to Asia and the Asian century. How does it compare to its regional competitors in Oceania or in nearby Southeast Asia? So these are the assets that our databases cover. We have oil, gas, we particularly cover LNG, all the base metals, gold is the precious metal we cover, and the bulk commodities, iron ore, coal, and we're about to commence coverage of steel. It's a very busy map. There are opportunities to participate in all of those commodities across the value chain and at different stages of development globally. these assets that are on the map are a combination of both operating assets, those generating cash flow, and projects, those that require investment to bring them up to cash flow generating stages. The majority, though, of production will be sourced from the non-OECD world. Now, I don't want to bore you with graphs and tables, but please take away that the large blue bars on the top are larger than the smaller, lighter blue bars on the bottom. That's pretty much it. It doesn't matter whether we look at gas, piped gas, LNG gas. It doesn't matter whether we look at oil, crude flows or product flows. It doesn't matter if we look at various base metals. It doesn't matter if we look at bulks. The ratio remains the same. If you're going to participate in the resources game, you need to have the capability to operate outside the OECD. But also, what does this mean for making money? That's what investors are here for. That's how cash flow is generated. And certainly from a government perspective, unless assets are generating cash flow, there's no government take. So again, the proportion here of non-OECD revenues much greater than the opportunities to participate in the developed world. That's a fairly blunt analysis, though. Essentially, all I've done on this map is taken our other map and taken out the developed countries. What does that mean, though, for who PNG's competitors are? Who are we talking about here are these developing countries? Warning, this is potentially where development economists in the room will be able to highlight that I've got this all wrong. But the different international organisations involved in assisting developing countries classify them in different ways. In the case of PNG, you could use the UN Development Programme definition of human development potential, and that would mean that you were thinking about issues such as life expectancy, education, and incomes. You could think about just pure incomes per capita and rank countries on that basis. The IMF has a fund focused on reducing poverty in the developing world. You could look at membership of that fund or non-membership of that fund. But if you combined all of those, and trust me, that's as far as into the economics we're going to get. If you defined all of those metrics, combined all those metrics together and tried to define who Papua New Guinea's peer group was, there's just 9 countries who share the same income level as used by the World Bank, the same development stage as used by the United Nations, or also share membership of the IMF Trust. If you look at the peer group, though, for Papua New Guinea, a couple of things come through. Papua New Guinea on this graph is a light blue. Sub-Saharan Africa is a light blue. Papua New Guinea is a light blue. Sub-Saharan Africa is a light blue. But in terms of incomes, Papua New Guinea, with its resource endowment and existing base of development, has a relatively high income per capita amongst the developing world. It is less comparable to Sub-Saharan Africa and more comparable to places like Southern Africa, South America, and Asia. But those 154 odd non-OECD countries, not all of them have the same resource endowment or the same market opportunities that Papua New Guinea has. So if we narrow down the set of countries we look at, we can think through how resource wealth is used, what proportion of the GDP derives directly from resources projects or assets, how much fiscal spending by the government is sourced from taxation from resources projects, what's the proportion of export earnings that derive directly, again, from those projects. These figures for PNG are from 2009. I've just bracketed the peers next to it. If you look at GDP percentage, 5 to 10% gives you a dozen countries. If you look at budget spend, it's 24 countries in that less than 25% range, and again, about 24 countries where export reliance is quite high.
We'll return with more of that presentation on Resource PNG right after this break. In this segment, Mick continues his presentation, drawing examples from South American and sub-Saharan countries. He highlights how PNG compares in export reliance to some of the oil giants in the Middle East and identifies a pattern with other resource-rich developing countries.
Looking into this in a little bit more detail, we can see some of the countries where perhaps the role of resources is quite important, but the dependence by the government on government take for spending isn't as high. And this suggests that maybe we should be looking at some of the South American countries, maybe some of the sub-Saharan countries. If we look at export reliance, the suggestion's also there that we should look at some of those countries, but it's really quite stark how Papua New Guinea's reliance on exports is right up there with some of the petrostates in the Middle East. If we pull that all together and try and then position Papua New Guinea relative to other resource-rich developing countries, a couple of clear patterns come out. Now, this data has been sourced from third-party sources, from Thomson DataStream and Economist Intelligence Unit, and we've just put it together to try and give us a relative ranking of some of the other parameters from our databases. So Papua New Guinea, again, right up there with some of those oil states. We've also highlighted some peers that we think are useful to talk about, and we'll be moving on to that. If we look at upstream development spend, though, you can see Papua New Guinea's spend is quite small next to some of those classic oil countries that you would think of. So whether that's Nigeria or Angola or Russia. We think of capex that will be expended in the metals and mining space. The spend that will happen in Peru, in Russia, in Mongolia is really quite significant. Papua New Guinea also in that scale. But what interests me is other countries have gone through this before, and so has Papua New Guinea with copper over many years. So what lessons could we learn? For LNG, we've looked at a range of countries we could look at. Yemen we've chosen. It's right next to Qatar, which has been very successful. Yemen less successful. Why is that? We've looked at Atlantic LNG in Trinidad and Tobago, a very successful LNG project. They're looking at going up to their 5th train. And we looked at Peru LNG for some of the obvious comparison points to Papua New Guinea. When it comes to copper, we've kept things consistent. We've looked at Peru, quite apart from its role in the copper market itself, means that we can look at another country like Papua New Guinea that is exposed to both copper and to LNG. Looked at Chile as one of the largest producers, and at Zambia, which was mentioned in our previous presentation. So firstly, Yemen LNG. It's a 2-train facility. It has a history that dates back to discovery in, I think it was 1998. Exxon participated initially and then withdrew from participation. And there was an arbitration between the initial joint venture partners, the Yemeni government, that ran from 2005 to 2008. It's been troubled since then. It commenced production in 2009. That's only 3 years ago. Last year, it had 3 supply disruptions due to bombings of the pipeline between the upstream field and the LNG plant. That's obviously a non-ideal situation. The annualised rating of the plant obviously moves downwards with those supply interruptions. So what do we have there? In terms of thinking through how this resource has been monetised, you have a partner that chose to exit, you have an ongoing dispute at the access stage. Development was successful, however commercialisation is now threatened by the ongoing political instability in the country. If we move over and think of copper, I picked on Zambia. It was already mentioned that Zambia's had a significant copper production decline over many years, and there's been different movements there in how assets are developed and commercialised. Since privatisation in the 90s, production actually recovered as the environment became more stable and easier to do business. Obviously, with the fiscal changes that have happened this year, we'll see what happens on an ongoing basis. But Zambia is an example of a country that had a market share exceeding that of the dominant player, Chile, just a generation ago, and is now troubled.
Stay with us. We'll have more from Mick Fell right after this break. Thanks for staying with us on Resource PNG. We've looked at some of the challenges involved with managing resource-driven wealth in developing countries. But what about the successes? Mick now takes us through some examples from Trinidad and Tobago.
What about successes? If we go to Trinidad and Tobago, access was quite simple. The participants there were able to negotiate the second, third and fourth trains as the first train was being conducted. The project was separated with different terms for the upstream plant, and all of those agreements moved through smoothly. Further commercialisation potential exists. They're actually looking at a fifth train. Now, Trinidad and Tobago is an interesting one in that when you do the work on per capita incomes, I'm sorry to return to the development economics, Trinidad and Tobago pops up into the OECD range of very high incomes on a 5 to 10 year cycle, miraculously following the oil price. So the wealth that's been generated by the LNG facility has flowed through to per capita incomes in the country. Another one that's worth highlighting is the fiscal terms. The first train, there were slightly different fiscal terms to incentivise investment. The second, third, fourth trains, some of those incentives were removed, but that fiscal stability has been there, enabling commercialisation. If we looked at Chile, there are some challenges to ongoing development and commercialisation, but extremely stable regime. That means that some of the big investments that people are talking about, be that desalination plants, hugely expensive ways to provide the water needed for minerals processing, are being looked at as serious economic options because investors can look at their 20-year horizon in the country and look at payback periods, feeling comfortable that they'll get their returns. I mentioned before that we might just use Peru as a proxy for Papua New Guinea or a comparator point. Why is that? There's a couple of reasons. We were brainstorming in the office and we thought, where's a country that has mountains, difficult logistics, landowner issues, that has an LNG plant and a copper industry? And we picked on Peru. There's a single project, just like PNG LNG. It has had its issues. However, it's moved forward strongly, is now producing. At the same time, the copper industry has been in place, but is becoming more threatened with changes to environmental, water and Indigenous rights legislation. What does this mean for PNG? Now, the framework we've used for these case studies is we've looked not at multifarious variables. We haven't looked at 5 different types of tax or 3 different types of government policy or 7 different types of commercial structure. We've kept it very simple. You're either at the stage where you're trying to get into the country or get into the resource and figuring out if it works, and you need to be incentivised or attracted to participate. Or you're at the stage where you've made the decision to invest, you'd like to participate, and you're looking to control costs as you develop the project. Or finally, you've sunk capital, you've spent the money, and with a large negative cash flow, you're looking to get your return over a large number of years. Now with LNG, that's absolutely key with a 20-year time horizon. But with some of the bigger base metal projects, that's also true. A copper porphyry, in terms of the cash flow profile, also requires that long payback period if you're going to develop a major project. So we're going to take that framework and we're just going to apply it to our little region here. There's countries like New Caledonia, strong exposure to nickel. Fiji, Timor-Leste, they have strong natural resources endowments. But the obvious comparison points are Australia and Indonesia. just simply by virtue of scale, whether by virtue of scale of the economy or scale of resources activity. And what we're going to do is, introducing that idea with which we've used to compare it, we might just look at how you access resources, how they're developed, how they're commercialised, and just think through that. So in terms of access, you need to get the fiscal systems right. How much am I going to pay and government take? Is it going to be a profit share? Will it be a royalty arrangement? Will it change? State presence. What's the public ownership going to be? Contract sanctity. If I sign up for this, am I sure it's not going to change? And regulation in all its forms, whatever that might look like, and the way that and how that might change in the future. That will determine your country entry or market access decision. Do I want to be in Papua New Guinea? There are 1,350 people here. I assume most of you have got past that stage. Development. There are all sorts of things that could slow down or increase the cost of development. I won't necessarily try and ascribe any of those to Papua New Guinea. The examples on the right-hand side are just how we might do it in terms of looking at the impact on value that's unlocked and the likelihood of that, to try and build up some sort of quantitative approach to enable us to think through what risk looks like in terms of dollars, in terms of those commercial outcomes. But they're all quite logical. I mean, is it safe to do business? What's environmental regulation like? What's the political environment like? Is it stable, as we've discussed earlier in this session? What's the propensity for natural disasters? And what's the labour force costs and relationships like? Infrastructure is one of the key things we look at in terms of the potential around commercialisation. And that's infrastructure in all its forms. That's not just a highway between point A and point B. That's the educational frameworks, the health frameworks, et cetera, that as a country develops that you need to have to run a successful business. The geopolitical concerns. I mean, Papua New Guinea is very lucky in its location in the world. We don't expect a neighbour to have a war anytime soon or for civil war to break out. That's a very fortunate thing. Domestic demand. In some countries with very high populations, the demand to retain resources within the country to meet domestic demand is sometimes regulated. That's a risk for external investors. And finally, how do you repatriate any earnings that you've earned? How are you able to remove earnings from the country? For those who may or may not have been invested in Argentina 5 years ago, that might be a biting memory. The scatter that I've got there is indicative only, but I think if we think through then Papua New Guinea's peers, we can think through what actually is the investment risk or what actually is the challenges that we should be worried about with Papua New Guinea.
Mick leaves us with an interesting perspective in this segment. If we think through PNG peers, we can think through what the investment risk may involve and what challenges we should be worried about in PNG. We'll be back with more after the break. Welcome back to Resource PNG. If you've just joined us, we have a presentation by Mick Fell of Wood Mackenzie Consultancy discussing the experiences, challenges and successes involved with managing resource-driven wealth in developing countries. In this last segment of Mick's presentation, he talks about cost blowouts and the level of productivity of the PNG economy, highlighting that the issue is not relatively pertained to access or development, but explains why the issue is more to do with commercialization and how certainty around aspects of commercialization guarantee lucrative investments.
In the opening remarks, it was mentioned that there are about 40% of us are Australians. And I think those remarks would be supported by us about our own economy and about our own resources investments. The situation is a little bit different in Indonesia. Cost of doing business is quite low, projects are being well delivered. But I don't really think that our issues are with access or development. I think our issues are with commercialisation. These large world-scale projects have long payback periods. How is it that I'm going to get my money back or be exposed if you're making a counter-cyclical investment to the upswing in the commodity cycle? And the answer is if you have certainty around those aspects of commercialising your investment. The infrastructure will be there, fiscal terms won't change, there'll be no geopolitical problems, etc., etc., etc. These are indicative only, but perhaps we could say that access in Papua New Guinea might be moderately better than in Indonesia or in Australia. We could say that. Indonesia is a difficult place to enter. It helps to have a local partner. I don't think that Papua New Guinea's investment environment is as tough to enter. Australia is getting tougher to enter with FIRB. What does it look like for an Asian country rather than an Australian country to get a resources investment up and running in Australia? We could perhaps say that Australia is a more difficult country to access. I think this is a matter of opinion. The key here is thinking through at each stage where you feel that your risks are positioned for each of those markets, and being able to take a decision then around your portfolio as to which risks you'll take on for which rewards. The development stage, I think this can be arguable. Is Papua New Guinea a harder place to develop an asset than Australia? Is it more likely to have problems? Again, arguable. But returning to our key point here, and these positionings are indicative only, and just to ask questions of you as an audience and think through these issues. When it comes to getting the money out of your investment, how does Papua New Guinea rank on commercialisation? We heard before about the lack of change in fiscal terms, the lack of fiscal risk or the stability there in Papua New Guinea. I think that's a key thing to be thinking about as you compare the allocation of investment funds between opportunities around different countries in the region. With your business, how are you going to screen opportunities? How are you going to think through where it is that you want to invest? We're all here because we're looking at opportunities in Papua New Guinea. How do they really stack up in terms of the value you're going to unlock and the risk associated with them? We also thought through resource-rich countries and their reliance either in terms of economic activity, government budgets or export earnings on resources wealth. If these countries are already rich with resources and are already earning revenue from resource activity that's taking place, what can you bring? As an investor, if you're participating in a country like Papua New Guinea, is it just about the fiscal terms, or is it about bringing something from your home market, the capability you have, and transferring it to Papua New Guinea? Finally, if you are an investor, and the point I've stressed all the way through, how do you get your money back? And how do you make money? Stability, absolutely key here. If you feel comfortable with getting access and developing the project, the key thing for the long term is how you'll commercialise that asset and earn steady cash flow. Finally, risk is arguable. I could come to you with an asset risk index with a quantitative approach and tell you that PNG out of 100 scored 85 and Australia was better because it scored 65. However, that doesn't allow for returns. And so your perception then of risk in investing in either country will depend on what you think are the opportunities. A thought there on portfolio management. If you have all your eggs in one basket and something good happens somewhere else, you're not exposed to that. Vice versa, if you're too spread, how will you then be efficient in unlocking the upside in particular countries?
And that was a presentation by Mick Fell of Wood Mackenzie Consultancy, concluding his presentation by challenging investors with their businesses how they're going to screen opportunities and where they want to invest, and how opportunities in PNG stack up in terms of investment value and the associated risks. When we return, we'll join Professor Magnus Eriksson with a presentation on mineral commodity prices. In this segment of Resource PNG, Professor Magnus Eriksson discusses mineral commodity prices. He talks about metal prices to illustrate how strange it is that we're worried about prices that are on high levels. Professor Eriksson puts into perspective where we are in terms of global mining and where PNG stands.
I've been asked to talk about mineral commodity prices, and I'd like to say that I will take a long-term view. I think that the present attitudes of doom and gloom almost are too negative. I'm an optimist, but I'm not a born optimist. I'm an optimist by studying the facts of demand and supply of minerals. And I'll show you first a couple of slides of metal prices, and just to illustrate how strange it is to me and to you, I'm sure, that we are so worried about prices. Gold price here looks fairly okay. Copper, indeed, also on high levels. I haven't updated these to the last quarter of a minute or quarter of a week even, but it shows that they are on high levels. Nickel, the third important aspect for PNG, not doing so well, but still at least twice or 100% higher than it was 10 years ago. And just to finish off, even iron ore, which is not mined yet in PNG, but where prices have dropped, and they've dropped a little further than in this slide here, but they're still around $100 to $120 per ton. That's a deep dip from the 180 we saw half a year ago, but still 5 times higher than what was the situation in the early 2000s. And I think that is the starting point that we must have. Prices are still at high levels. They're not at the exceptional levels that we saw a couple of months ago, but very healthy still. So I'd like to show you some of the slides just to put you in the mood of where is global mining. And I think it's quite interesting, and now I can only point at one of these screens, that PNG is almost in the center of the world when you have this perspective here. But if we look at this map, I think we should look at China. China accounts for 15% of total metal production in the world, and its domination is even higher when we include coal. A third of all mining takes place in China. And so I think that's good to have at the back of your minds, that it's not only an engine of demand, China, it's also a very important mining country. The value of metals produced in 2011 is shown here, and my key point is really that 3 metals give us more than 60, almost 70% of the total value of production. The green, that's iron ore, copper is red, and gold is the yellow, of course, here. And it is interesting to note that PNG is involved in both the copper and gold, which are key elements here, really. But looking at volumes, and some of this presentation material I brought out for politicians in Europe. I'm from Sweden, have a long background in PNG, been working with government and the MRA since 2000, really. And I think we should keep in mind here and just realize the different scale volumes that we're talking about. Iron ore, 2,000 million tons annual production. Platinum group metal, 200 tons, and gold, 2,500 tons. Rare earths, which politicians all over the world are focusing very much, which I think is a very misplaced interest. 130,000 tons, while copper 15 million tons. That gives you the background in that sense. I think also, and I think you've already sort of noticed that, I think it's important to take long-term view, particularly of mining. And this is my first slide with 100 years, just to give you how the demand for metals have been growing over this period. The top, and it's a logarithmic scale, so So each division there is 10 times more than the earlier. The black top line, that's aluminium, and all the other metals follow there. So even the metal with the slowest growth have grown production 5 times over these 100 years. And finally, a slide over prices, just to also give you a long-term perspective. Copper here has gone through a cycle, 2 cycles really over the past 100 years. And as you can see, copper prices are at very high levels today. And I think it's quite reasonable, and I'll get back to that, to forecast for the future a steady growth over a number of years into the future. So my agenda today, and let me summarize before that, some facts. Society needs metals. There is no going back to other usages, which again in Europe, in Japan, in the North America, there's a lot of talk about recycling, etc., and that might solve some of the problems, but mining has to be there to supply the growth for economic development. It's a global industry. I think I'm a good example of that, flying all the way from Stockholm here. Iron ore, copper, and gold dominates here, and once again, it's a long-term business and a cyclical business. We mustn't get too worried about little humps in developing to the future. And so far, it's a booming sector. Well, that's my agenda. I've already covered the background facts. I will cover demand, supply, and then summarize a bit and try to look into the future. Before that, I'd like to tell you a little about Raw Materials Group. We merged earlier this year with Ingera out of Perth to form a global metal and mining consultancy and data provider company. We have now close to 100 employees all over the world in 5 offices in Canada, the UK, Sweden, and Australia. And, well, the rest you can read there, really. Let me then start with the demand and my views of demand. These cartoons here, by the way, are illustrations of elements that were first isolated by Swedish chemists. I'm a chemical engineer, as you could imagine. Another long-term slide. This is Chinese and global economic development over 1,000 years. The gray part, that's Asian countries except Japan. And you can see how the Asian economy has dominated the world over several hundred years. It's really only in the past 100 years that China has come into decline, and it's now coming out of that again. So the Chinese growth is really only coming back to a position where they've been over the past 1,000 years, really. Metals are and have special properties which makes them very difficult to substitute. I've summarized most of them here, and I just like to highlight that they conduct heat and electricity. No other material really does that, and still they are fairly low cost. Behind the growth in demand for metals and other materials for that matter is 3 factors. First of all, population growth. And that's illustrated in this graph here. And it's interesting that demographic forecasts are fairly easy to make, and these growth rates are very certain into the future. The second factor is urbanization. This slide illustrates simply how when you move up, the urbanization degree in general, that's that point here. Some 50%, that's the average. But when you move up, higher urbanization degree, the demand for metal every year increases, and that's the size of these circles here. So to summarize, I would like to talk much more in detail about these things, but let me just summarize on the demand side. Metals cannot be replaced. That was a dream in the 1980s that, you know, you could replace steel and other with carbon fibers, etc. It doesn't work simply. And the growth behind metal demand is the population, the urbanization, and also industrialization. And I think it's important to understand like in China, it's not only the Chinese Communist Party, the Central Committee of the Communist Party deciding that we should now build 1,000 kilometers of railways. It's the population, the middle income ranges of population in China that wants to lead a better life. That is really and that's a very strong force. And I cannot see that demand pull cease suddenly. It will increase, and it will come in other Asian countries. As I've showed you, it has done over several hundred years earlier. And finally, I cannot see this, the growth rate. It will slow down during the next 10 years, but it will still be there as a very strong force.
More of Resource PNG when we come back. Thanks for staying tuned with Resource PNG. In this last part of Professor Eriksson's presentation, he concludes with optimism the present stage of mineral commodity prices and presents a good indication to the future in terms of global mining.
Turn to exploration here and mining, the supply side simply. Another slide, this is 150 years, and I'd like to explain here a little more in detail. The different colors, the red there, that's how European-based mine production dominated mining in the mid-19th century. The blue line, that's US. Also, the US builds its economic and political fortunes on mining. The white line is the Soviet Union, later Russia, which sort of declined and dropped off of in 1990. China is the lilac line at the bottom, growing steadily. And then we have the yellow line, that's Australia and Canada, grow very fast in the end of the 20th century and then tapering off. While the green line, that's just an illustration of 6 emerging economies, 3 from Latin America and 3 from Africa. That is where the mining sector is most vibrant and will remain so in the next decade. At the same time, and these are facts that you all know very well, it's getting more and more difficult to start and to run new mine operations because mines are in more remote regions, more remote locations under more extreme weather conditions. PNG is really a good example of that. The grades of ore bodies are declining, which make them more difficult to find, more different to mine, difficult. They are deeper down, and then we have other, the permitting processes takes longer and longer time. All these are structural factors, structural changes that I cannot see suddenly end. The barriers of entry is increasing all the time. At present, we also have, and that's particularly difficult here in Australia, there is a lack of trained staff. Cost of staff has increased dramatically. And I'll try to illustrate that very schematically. These are cost curves out of our database, and there are 2 lines. The one is a bit difficult to see over there, but this is the cost curve 2002. This is the gold cost curve in 2010. It increased 183% in that period, while the price went up 409%. So still, there is a quick increase in production costs, but still profitability of the industry remains fairly robust. Another factor affecting the supply side is the corporate concentration. And here is a picture of the largest company in the world. This is situation 2010. Not much has changed in 2011. And I'd like just to point out that some of the companies, particularly in iron ore, not so much in gold and copper, but in iron ore, the corporate concentration is so high that there is at least risks of an interference with price formation by the major producers. And that is a factor that will also underpin prices into the future. So summarizing the supply side here, We see how mines are moving to emerging economies, developing countries, production costs are increasing, and corporate concentration, take iron ore as an example, is so high that that could actually affect prices. So the difficulties in supplying or covering demand into the future is increasing all the time. So what does this mean to metal prices? Well, this is our forecast into the next couple of years, and we made this earlier this year. It might be that we're a bit too optimistic about 2013, but the key thing here is really that we will not go down to the levels that we saw here in the beginning of this decade. We will remain into the future somewhere in between. And there is, in my mind, that is a very good indication into the future. So let me simply say and summarize on the price situation here. Well, the doom and gloom and the crisis, I cannot see it is really there, not yet at least, and I don't see it coming for the rest of this decade. Prices will fall, but they will still remain on a healthy level. We will not see a return to the situation which was so devastating in the end of the 1970s and into the 1980s and even into the 1990s, where the bottom really went out of the market. That will not happen. So let me simply conclude, ladies and gentlemen, here. Demand grows with economic development. China and India and Asian countries is really behind the demand growth here. We see how on the supply side the barriers of entry are increasing all the time. I haven't discussed, but I think it's an important aspect, that state interests in the mining sector are on the increase very strongly and will affect markets into the future. There is no doubt about that. On the government side also, government policies will affect how attractive a country is to invest in. And this is an area where we in the Raw Materials Group have been working with MRA to do investment promotion for PNG around the world. And I think that PNG, as an example, has a much better and is more attractive than measured by some of the indicators that was discussed. I don't want to mention those indicators. I think they are severely underestimating the potential of PNG. I think there is a need for a more objective measure of how attractive PNG is. Finally, and I've said that many times already, prices will remain on a high level. They will not be at the top levels that we have seen, but they will be very healthy into the future. And I think that for countries like PNG and other emerging countries, there's no doubt that there is a strong decade ahead, and this can be used for kickstarting other sectors of the economy. Thank you very much for your attention.
And that's how it is in this edition of Resource PNG. If you want to know more about the program, do email us on this address, resourcepng@mtv.com.pg, or check MTV online, that's www.mtv.com.pg, and go to our Resource PNG page. Until the same time next week, have a pleasant evening.